How's it going, everyone? So we have an interesting video for you all today. We're going to be talking about Michael Burry. Michael Burry, you all know who he is. I'm not going to say who he is. He's the guy in the movie The Big Short. He predicted the 2008 housing market crash, and he made a whole bunch of money through his prediction because he shorted the housing market. Now, if you are big in the Twitter space and you follow Michael Burry, you'll go into his account and you'll most likely see nothing on his account because he makes tweets and then he deletes them straight away. That's just the way he does it. I don't know why. But luckily enough, there's this other account called Michael Burry or Burry Archive, where this smart guy, whoever made the account, he screenshots the tweets from Michael Burry and he uploads it to his account. Michael Burry Archive, if you want to check it out. Anyway, so interesting tweet that Michael Burry has released very recently. This was the 7th of September for anyone who cares about that. But this is what he said. He's talking about the market and are we at a bottom? So I'm not sure if you've seen this tweet or not, but Michael Burry tweeted, "No, we have not hit bottom yet. Watch for failures, then look for the bottom. 2 Spec ETF failings is not near enough." So what does he mean when he says 2 Spec failings is not near enough? So this signal of Spec failings or company failings is just one of many signals, one of a bigger picture to look at when trying to predict a potential market bottom. I know Warren Buffett, he doesn't like to predict where we are in the market cycle, but I do think there is value in trying to get a feel for where we may be in the market cycle. And Burry, he clearly thinks the same as well. So one thing we all need to know about the market is it does run in cycles. We all know this. For a long time, often the market will go up. This is called a bull market. And then often this bull market turns into a crash known as a bear market. So the market runs in cycles of periods where investors become more greedy, they want to buy, the market's going up, everyone sees this, there's a lot of money in the system, and often during the end of these bull market cycles where there is just so much money in the system, companies can take advantage of this free money and they can make businesses that aren't really sustainable. But when the bear market comes, it wipes out these unsustainable businesses that have just been formed because there's so much money in the system and there's so much greed in the system. And it's what Warren Buffett says, when the tide goes out, the bear market comes, you discover who's been swimming naked, what companies are not sustainable and they don't have a true business model. So often during the end of a bull market where you may see a bottom, you're going to be seeing a lot of companies failing. And this is kind of what Burry is getting at when he says 2 Spec ETF failings is not near enough. He wants to see a lot of these businesses failing before he thinks we're at a bottom in the market. If that makes sense. I don't ever profess to be a genius at this, but I hope that makes sense to you guys. Now, some of you might be wondering, what is a SPAC? What is he talking about when he says SPAC? Okay, let's get into it. So a SPAC is what's known as a special purpose acquisition company. It's a company without commercial operations and is formed strictly to raise capital through an IPO or the purpose of acquiring or merging with an existing company. They're often called blank check companies because they don't actually have anything in them. SPACs are often an alternative to IPOs, and it says here, they have the potential to de-risk and shorten the IPO process for their target companies, often offering them better terms than a traditional IPO would. But when you shorten this process and you offer investors less information, it increases the risk, okay? So it says in the Harvard Business Review that when the researchers Michael, and Emily analyzed the performance of SPACs from 2019 through the first half of 2020, they concluded that although the creators of the SPACs were doing well, their investors were not. Another potential cause for concern is that all sorts of celebrities and public figures, from the singer Kiera to the former US Speaker of the House, Paul Ryan, are jumping on the bandwagon. So you're seeing these celebrities and famous people hopping on the bandwagon of SPACs, but they're often doing this as a way to make themselves wealthy, not necessarily their investors. Compared to traditional IPO, SPACs are sometimes less transparent with less information released to the public. SPACs themselves make no products, offer no services, and don't sell anything. They exist purely to raise the money needed to merge with a private company to take it public. The merged company then uses the money to deliver on its growth plans. So essentially, they're a much riskier, less transparent version of an IPO. That's kind of the way I see it anyway. And there's no surprise that Charlie Munger, the great investor, the legendary investor, he's been not afraid to say what he thinks of SPACs. So let's take a look at what Charlie Munger says about them.
I don't participate at all, and I think the world would be better off without them. I think this kind of crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble. It's just that the investment banking profession will sell as long as it can be sold.
Yep, so Munger, he's never afraid to mince words, and he can see the risky behavior in SPACs and the incentives that are often behind SPACs, which is to make the people who form it money, not necessarily the investors. Now, okay, where does this all tie in with what Burry tweeted? Well, interesting enough, over the past couple of years, SPACs have really grown in popularity. In 2019, 59 were created with $13 billion invested. In 2020, 247 were created with $80 billion invested. And in the first quarter alone of 2021, 295 were created with $96 billion invested just in the first quarter. And in 2020, SPACs accounted for more than 50% of new publicly listed US companies. So, as of the past couple of years, SPACs have grown and grown in popularity. Investors have been less cautious. They don't mind throwing some money at more SPAC IPOs because there's just so much more money in the system. And now that 2022 has come around, we have seen a couple of SPAC failings. That's what Burry has alluded to with his tweet. But there has only been 2 failings, and Burry wants to see a whole lot more than just 2 before he sees a bottom in these riskier types of IPOs, these less transparent types of IPOs. Just 2 failings, that is not enough. So what do you think? How important of an indicator do you think this is when trying to predict a bottom? I always say, look at all of the indicators, look at all of them, and then get a feel for where things may be in the market. So I just want to know from you guys, how much of a percentage do you weigh this type of indicator when you try and get a feel for where we are in the market? Do we need to see much more than 2 failings before we see a bottom?